If you have money in a savings, the US government is doing something that they haven't done in 80 years. And I need to show you exactly what they're doing. And most people are never going to realize that it's happening to them until their savings accounts are worth half of what they are today. And I'm not talking about a crash. I'm not talking about a recession. I'm talking about deliberate, legal, mathematically inevitable transfer of wealth that's happening right now. And you are on the wrong side of it. Today, I'm going to break down that exact playbook and show you how you can get on the other side of it. Because if you look at it, this number, $38.5 trillion. Let me put this into some perspective. That's 115,000 for every man and woman and child in America. If you're a taxpayer, that share is over $275,000. But here's the number that everybody ignores. It's the amount that is accrued over the entire year, because we're spending over 1 trillion per year on interest, not paying down the debt, literally just servicing it. That's almost $3 billion per day going to bondholders. And that's the part that should terrify you, because for the first time in American history, we're starting to see spending on interest payments more than national defense, which we literally have never seen before. And when we keep looking at how much this national defense is comparatively, right? It's more than the entire Pentagon budget. The fiscal year of 2025, we paid $970 billion in interest and $917 billion in defense. So we're paying more to the bondholders of the past than we are to protect our own country. So what do you do when you owe $38 trillion worth of debt and it's inflating away? And our currency that we have is now growing, or the debt is growing by $56 billion a day. Well, you have to inflate that away. You have to make the debt worth less. So this is why they want inflation to occur, because of what I'm lining out right here. Because you have two essentially options. You could do massive spending cuts, right? I mean, you see this outside of the interest payments. You can cut everything else. You can have huge tax increases, double the income on taxes, cut Social Security by 30%, abolish Medicare. And you know what? Politically, this would be suicide. Any politician who proposes this would get voted out immediately. The economy is addicted to government spending. So if you pull the plug on that, you'll get an instant depression. So that's basically off the table. Then the second option is just to refuse to pay the debt. You know, this is what Argentina did. This is what Russia's done. But for America, they're the issuer of the global reserve currency. So this would be essentially nuclear, especially when, even though we have this debt clock ticking up like crazy, every pension fund, every bank, every trade contract on earth is built on the assumption that the US treasuries are quote unquote risk free, right? So when we look at this and we see that the default would mean that the global financial system collapses overnight, credit cards will stop working, trade will stop, there's a financial apocalypse. So the explicit default is also off the table. That leaves option number 3, the option every empire in history has inevitably chosen. If you've looking at the past, it's Rome, Weimar Germany, post-war Britain. It's the path of least resistance, and it's what I call the soft default. So from this, even though you see the recent balance sheet and trends of the Fed, you refuse to pay back this debt. You pay back every single cent. You don't refuse, excuse me. But when you pay it back in a currency that's worth significantly less than you borrowed it, you can just keep printing the difference. This isn't a conspiracy theory, though, folks. This is a documented policy. This is what the United States has done before, and this is what they will continue to do. They will continue to print their way out of this debt so they avoid any types of default when it comes to having to pay and service that debt. So when we keep it going a step further, right, if you look at the previous IMF playbooks from what we had seen, right, and the public debt after World War II, this is something that has happened before, right? In 1945, the US debt to GDP ratio hit 106%. It's higher than it is today. The government didn't pay it off with taxes. They didn't default. They ran something called the financial repression for almost 30 years. So here's how it worked. The Federal Reserve capped interest rates at 2.5% by law. So they did that by law. Meanwhile, inflation averaged over 6%. So think about that math. If you bought the government bond earning 2.5%, but inflation was 6, you are already just agreeing to lose that spread of 3.5% immediately, just from your purchasing power. So in the end, who won on that, right? It was the government. The debt shrank in real terms, but who lost? Anyone holding bonds, anyone with savings. So the middle class got absolutely crushed. But by 1974, the debt to GDP ratio had fallen from 106% to 23%. Not because they paid it off, but because they inflated it away, right? So continuing on from this, there's plenty of IMF research that will confirm this point. This is what they are researching essentially, right? It's, hey, without interest distortions and primary surpluses, the US would not have grown out of its World War II debt. This is direct quote from IMF, right? And this is an academic consensus now. So they're doing full-fledged research papers on what would happen and what the debts were, right? So, kind of going back into the post-World War II playbook that we have here, it is something that, these researchers and the previous governments, they look at what happened in the past to assess what is going on right now. Because in a free market, if the government is in $38 trillion worth of debt and is spending recklessly like they are, investors would demand that 10% interest to lend them money, right? Because they would say, hey, government, you're risky. Pay me more. But let's be honest, the US can't afford this 10% interest. At 10% interest on $38.5 trillion debt, that's $3.8 trillion a year in just interest payments, which would be more than all the federal tax revenue combined. So what are they going to do? They're going to rig the game, right? Because when you have the global reserve currency, you make up the rules. So through the regulations like the Basel III, the government has forced banks, pension funds, and insurance companies to hold U.S. treasuries, which then regulators have now classified these as quote unquote risk-free, right? And this would assets with zero risk weight, right? So your bank doesn't want to buy this stuff at 4%, right? They have government bonds when they could earn more elsewhere. They're required to. This creates a captive buyer, a guaranteed market for government debt that doesn't reflect reality. And then when it comes to inflation, what else do they do? Well, they report the biggest lie, CPI, right? So when we look at the government data, they do something called a hedonic adjustment, which let's just show you how it works, right? Because, when you see this data, you're like, all right, I could believe, what this government's putting out, right? They're not going to change or manipulate or change the underlying, structure of it, right? Well, here's where you're wrong, right? Because let's say a Toyota Camry cost about 20 grand in 1995. Today it costs maybe, let's say 30, right? That's a 50% increase. But the BLS will say, no, the Toyota Camry has better airbags, a backup camera, improved transition, and all of that kind of stuff. And then that has made it cheaper. So when you see how all of these things are lining out, right? Here's the problem. You can't buy a 95 Camry if you need a car to pay that $30,000 period, right? Because when you adjust the price for the quality improvements, they'll say the adjusted price is only a 10% increase, even though it was 50% on paper, right? So the government will use this to report lower inflation than your actual expenses, because they'll give every percentage point and try to manipulate every percentage point as possible. So, when you continue to look at how this is playing out, right? The government debt, the assets, the Federal Reserve balance sheets, they're all looking at a third tool, or the Fed as a last buyer of resort, right? Because when foreign countries like China and Japan stop buying the US debt, right, the Fed has to step in and print money to buy the bonds when nobody else wants to. So before 2008, the Fed's balance sheet was under $1 trillion. Today, after quantitative tightening, it's still at 6.5 trillion. But by buying government debt, the Fed artificially suppresses the yields. This keeps interest payments affordable, but it floods the economy with new dollars. So the results are the stock market goes up, real estate goes up, and everything you own goes up in a nominal price, right? So we keep breaking this down. The Fed is going to continue to print money in order to service this debt. And then when the Fed prints money to service this debt, well, we'll see that the inflation will keep going up. So who continues to suffer? It's that middle class, right? So, I mean, I'm curious what you guys think in the chat. Do you guys trust this official inflation numbers? Let me know in the chat, in the comments, because I'm curious if you believe all of this reporting here. Because at the end of the day, when you look at the way that these numbers come out, it seems like there's a major disconnect between Main Street and Wall Street, right? People that are maybe watching this, getting some breakdowns, looking at the numbers, are really feeling that pain, right? I mean, we saw the eggflation and all the things that made headlines previously before, and now we're starting to see it in other areas, and it's simply unavoidable at this point. So I'm going to keep diving into this, but make sure you guys are subscribed for me. Literally 93% of you guys are not subscribed, so make sure you guys are, because we're going to go over the Cantillon effect on how this is showing showing true here, because the Cantillon effect is actually kind of makes me angry here, because everything you've been told so far sounds a little abstract, right? But from here, there's a real documented mechanism for how this transfers wealth from you to the financial system. So here's the Cantillon effect, and like maybe some simple terms in a sense, right? So the Cantillon effect is when the Fed prints trillions of dollars, they don't mail checks to every citizens, right? They don't drop it from helicopters. They give it to the financial sector. They buy bonds from Goldman Sachs, JP Morgan, BlackRock, and these institutions to get the new money first at zero interest before the prices adjust. Then what do? They buy assets such as stocks, real estate, tech companies, bonds, Bitcoin, all of those things. And then by the time this money trickles down to you, maybe in the form of wages, stimulus checks, prices have already risen, right? They've already seen things go up. So the rich get this money before because they're closer to that money printer, right? And then you get the money after the inflation. So when you see, that the tax cuts don't really, help the rich or help the inequality, right? You'll see that, this is why in 2008, we've seen economists called for a K-shaped recovery, K-shaped economy, right? The asset owning class, the top 10%, their wealth exploded. The Fed pumped up their value of stocks and homes. The wage earning class, on the other hand, the bottom 90%, their purchasing power collapsed. So wages couldn't keep up with rent, groceries, healthcare, you name it, any type of expense. They just really just fell farther and farther behind, right? So at the end of the day, when you keep looking and diving deeper, the national debt is effectively being paid off by liquidating the Americans' middle class. So this is why we see the growing, debt and growing, middle between the upper class and the middle class, or the upper and the lower class, and they're essentially killing off the lower middle class. In 1985, baby boomers bought homes at 3 times their annual income. Today, Gen Z, millennials, it's literally 8 to 10 times the income. So since 2008, the money in supply has increased by over 150%. Meanwhile, wages are up by 10%. So, I mean, at the end of the day, folks, this is not conspiracy. This is not blaming one party or the other. This is simply just facts and just numbers. I mean, we can look at all the data. They can manipulate some of that data as much as they want. But when we really start to break it down, folks, that Cantillon effect is real, right? Because Wall Street will keep getting those bailouts while you won't, And I'm going to keep diving into some of the details and the numbers here, but make sure you guys are hitting that like button and subscribe to the channel because, hey, as they're saying in the chat, the worker bees aren't very happy at this point, right? Because it's always the result of the government being a petitioner, judge, and jury because the national debt is being serviced by the dollar debt, right? I mean, it seems like the Chinese and the Russians will keep going after some of the United States debt and selling some of that because let me explain a little bit why there is no escape from this because we've entered something called the fiscal dominance. For 40 years, the Fed was the master, right? Inflation rose, they raised rates. Even if it caused a recession, even if it hurt, Paul Volcker took rates to literally 20% in 1980 to quote unquote kill inflation. It did work, but today the Fed can't do that because the debt is way too high, right? Because if you did the numbers and you did the math, right, and you looked at how much we spend on a daily basis, right? If we spend 2.6 billion, imagine, 5x in that. That would be insane. Because currently, let's do some math, right? The current federal debt is 38.5 trillion. If the interest rates went to 10% like they did in the 1980s, annual interest payments would be $3.8 trillion. The total federal tax revenue in 2025 was 4.4 trillion. That means literally 86% of all tax revenue would go to just interest. That's it. Nothing left for Social Security, Medicare, defense, anything. The government would then collapse. So the Fed is forced to keep rates lower than they should be because they're forced to tolerate higher inflation. They've become enablers of Treasury spending. The independence of central banks is dying. The money printer is permanently fused to the government budget at this point because this is the hidden crisis. It isn't a sudden crash. It's a slow boil, folks. We are lobsters that just got put in the freaking pan and they just turned on the burners. We're starting to feel the water get a little warm, but that $38 trillion will keep growing. I mean, soon I'm definitely going to get to 40 trillion this year. Will it get to 50? I don't know, but it'll 100% get to 40 trillion. And the value of the dollar will keep going down. But let's just face it, the government is betting it can inflate away the debt faster than the market can panic. And it's a dangerous high water act. So let's take this and say, hey, what does this mean for my money? And how can I, I guess, get myself on the right side of all of this? Because at the end of the day, this is what we all worry about, right? We all see the market conditions that we have. We all see the inflations. We worry of the potential of the asset bubble, but how do we position ourselves in order to avoid or at least get ourselves on the right side of history here? Because this $2.6 billion every single day, right? The government's goal to run inflation at 4 to 5% for a decade will keep the interest rates low, but it's not manageable at the same time because at 5% inflation, the value of your savings is cut in half in 14 years. 14 years, folks. That's not that long of a time. So if you have 100K in savings and it's earning 4% on interest and inflation is running at 6%, you're losing 2% purchasing power, say, every single year. That's $2,000 at least evaporating every single year. The government will benefit and their $38 trillion of debt shrinks by that 2%, which is like $760 billion erased annually without raising a single tax cut or anything like that. It's just simply inflating it all away. So the bondholders will get their money back. The money will buy fewer groceries, fewer houses, a smaller life, and it'll be disguised as like supply chain issues, market shutdowns, all of these other things, right? So let's give you guys the bottom line is that the United States is defaulting on its debt. It's slow, polite, bureaucratic. I mean, they're not, you see the rising demographics of the amount of debt here that we will have when the population is over 65. And that $38 trillion will never be paid back in real terms. There will be winners who own the scarce assets like real estate, gold, Bitcoin, profitable businesses, things that can't be printed away. But the losers will be the ones who trust the currency at the end of the day, the ones who buy bonds, the ones that are trying to save their way to American dream, right? So at the end of the day, right, all you guys can do is avoid all of this by buying hard assets, getting yourselves invested, and doing all this. So make sure you guys are liked, subscribed. Thank you guys all for blowing up the chat. I really appreciate it. And I'll catch you guys all at the next one.